Welcome, everybody. This is Marc McInnis with CAM Investor Solutions, Wealth Advisor and Chief Investment Officer for the firm. I appreciate you taking the time to join us today. Today, I thought we'd cover a popular topic that a lot of people are talking about in the capital markets and the stock market, and this notion of growth investing. To be here with us today and share more about that is Phil McInnis, Vice President and Director of Investments with Avantis Investors. Phil, in his current role, oversees all marketing content, strategies around investment approach, talks to a lot of advisors, institutions to discuss various topics and explain Avantis' investment capabilities. He's got a great experience in the industry. He's served at roles at Dimensional Fund Advisors, also as a consultant at Towers & Watson. And so with his knowledge, I think he'd be a great addition to a lot of the next sessions that we've been talking about, on investing, on planning, and everything else. But before I begin, I wanted him to share a little bit more about Avantis, who they are, kind of the brand that they represent, and a lot of their initiatives. I think it's important for our audience to understand that. Welcome, Phil.
Thanks, Mark. Really appreciate you having me. I'm excited
Absolutely.
to be here. Yeah.
Absolutely. I thought maybe just for a couple minutes, if you can share more about Avantis, that'd be fantastic to give our audience some insight on who you are and kind of what you all do.
Yeah, sure. So Avantis Investors, we were founded as a part of American Century Investments a little bit more than a year ago. And so that was in kind of mid-2019. And what we do, we have really an approach that's based on financial science. We try to build strategies that are going to emphasize areas of the market that have higher expected return, and that's based on kind of valuation theory, as well as if we look at the long-term empirical research, it's supported by that as well. So we try to build portfolios that are very well diversified. They can fit together well inside an asset allocation and try to support investors who are looking for a good long-term outcome. So we've got a team of about 20 people who are on a dedicated basis, but we focus really on just managing the investment strategies, speaking with RIAs and explaining our strategies and how we expect them to perform in different market environments, building those relationships, and then creating a lot of content that supports the strategies themselves. And we're also really big believers in financial advice. We're big believers in supporting sound investment principles. So a lot of, there's a behavioral component to that that's super important. So we try to have some content that supports both the investment side of things as well as the behavioral side of investing as well. So that's what we focus on, and then we rely on American Century for everything else. So they've got huge teams, whether it's investment technology, whether it's HR, compliance. We're able to kind of leverage the resources of a larger organization. American Century's got about 190 billion in assets under management. So we get to be part of a great long-standing company that's got a great reputation in the industry, and actually has a controlling shareholder that's a medical research institute. So the Stowers Institute of Medical Research really focuses on genetic-based diseases, and so there's a portion of profits that go to funding that research from American Century. So we're really, really fortunate and feel happy to be associated with that.
That's great. No, thanks for that insight and for our audience and background. And I know that's across multiple ETF and mutual fund strategies, I believe, correct?
Correct. Yeah, we're big believers in choice, that there's multiple vehicles out there. And what we want to do is basically deliver a sound underlying investment strategy and let people choose the vehicle that works best for them.
Okay, fantastic. No, thank you for that. And so for our audience, why I thought Phil would be a great guest today is, not just recently, but also over the last, I think, several years, there's this topic around growth stocks, growth investing. Nothing new. We've seen it over time. Growth investing has been around, as we all know. But it's been interesting because there's this discussion around, this phrase, can growth stocks, and I'm going to steal your guys' phrase, can growth stocks get growthier, which y'all used in a recent piece. And really what they're talking a little bit about is this question, I think, in some of the industry around growth stocks and value stocks. And before we get into the debate, we'll call it, or the discussion of detail, maybe just for our audience, because I think not everybody sees the world the same, but at least in our world, define maybe growth stocks and value stocks, just so we're all on the same page to start with.
Yeah, absolutely. And I think, if you look back in history, growth stocks may have been referred to as glamour stocks. I think that there's a lot of layers or kind of levels that we can get into in describing what do people exactly mean by growth or value, but it's probably best to level set and just think about the top level. So if you think about the US stock market, let's take the Russell 3000 as a good example, right? It's the 3,000 largest companies a lot of people consider to be pretty representative of what the US stock market looks like and the companies that make it up. Well, all 3,000 stocks there are not the same, right? There are differences. And one way that you can judge difference is just in total size, right? So you have really large companies like an Amazon or a JP Morgan. You got smaller companies like a Yelp or a Levi Strauss, right? So company size is really just a function of the total number of shares outstanding and the price per share. So you can sort every single company in that universe based on their total market capitalization. And you can, basically start to distinguish between these are large cap stocks and these are small cap stocks. The concept behind growth and value is pretty similar, but instead of looking at just company size, we're going to start to look at a company's price relative to some fundamental ratio. And there's a lot of common ones that are used. There's book value, there's earnings, some people use cash flows, but basically the way that I like to think about it is that companies that are trading at a higher price multiple to some fundamental, right? Whether that's book value, sales, or earnings, those tend to be growthier stocks. And the ones that are trading at lower price multiples to those same fundamental ratios are value stocks. So we could just very crudely say, we're going to cut the Russell 3000 in half, put half of the companies on the growth side and half of the companies on the value side. We'd be using those fundamental ratios to go ahead and make that distinction.
Okay. No, thank you for that. And I know that's important because not everybody classifies growth stocks the same and value stocks the same. So thanks for sharing some of the metrics that I know, you all utilize in terms of helping to create that universe, if you will. So kind of stepping back to the last several years, we've seen growth stocks be taking, and maybe I'm jumping ahead here, but we'll get into the details I know in a minute. Over the past several years, growth companies have been outperforming value companies. It's been a hot topic, I think, for some of us that are in the industry and trying to understand not just how to position portfolios, but in terms of understanding what makes sense for clients in terms of taking risk. Given that you've seen that large outperformance of growth over value companies, is this consistent with what you might expect given some of the academic framework or academic research that you all have done at your firm?
Yeah, so I'm the lucky one. I'm the one that gets to be on the hot seat and answer this question. I think it's a very valid question. I think that there's no doubt about it. Growth stocks have enjoyed a very a good run as of late. Is it what we would expect to see over long periods or consistent with what we've seen over really long periods in history? The short answer is no. If you look back to, as long as we have data, right? So let's go back as far as 1926 in the US, and we compare the returns of value stocks to growth stocks, very, very broadly diversified portfolios of value stocks and growth stocks. Over that 90-year data set, you see that value stocks have outperformed growth by an average of more than 4% a year, right? So a pretty meaningful number. And there's things that related to valuation theory. We talked earlier about these fundamental ratios, right? And the idea that value stocks are really trading at lower prices relative to some fundamental. There's valuation theory that would tell you that you would expect those companies, the ones that are trading at lower price multiples, to have higher expected returns, right? You expect that things that all else equal in an investment, the lower price you pay, the higher your expected return. So there's valuation theory that backs that up. And like I said, with the kind of the empirical evidence, if you will, the numbers, what do the numbers say? The numbers say that value has won on average relative to growth. So that's really what we expect. But we also know that this notion of a value premium, which is, that outperformance of value versus growth stocks through time, it's not the same every single year. It doesn't show up every year. It doesn't show up every 5 years. We've definitely seen periods where growth stocks have done markedly better, but the long-term data still supports this idea that value should outperform growth over time.
Okay. No, that's interesting because I think for those who, even let's say folks who understand growth and value, how those stocks are selected, right, for different strategies, different funds, different indexes. That's great, but given the time frame of performance, some still get too attached to the numbers, as we know. I think let's fast forward a little bit to today, right? Today being this little pocket, we'll call it, of the last 5 to 6 months of COVID, which is has a lot of other things going on, of course. But you've seen growth stocks and predominantly some technology companies within that spectrum perform pretty well. Outside of the entire market, not just maybe value stocks. Some say it's justified. Others suggest maybe it's overdone.
Yep.
I'm not asking you to predict the future, but any thoughts there on just, again, kind of keeping it in that academic framework?
Yeah. I think, let's think about the year-to-date period, right? We're here sitting in August. If we look at the last 7 months of what's gone on from kind of the beginning of 2020 until the end of July, as you said, there's a lot that's changed in the world, right? The world feels and looks a lot different than it did January 1. We've definitely seen, if you look at large growth stocks in the US, they've outperformed large value stocks by about 30% over that time period. They've outperformed small value stocks by a little bit more than 40% over that time period. Those are massive numbers. And so I think, clearly you kind of hit the nail on the head of people have a debate of, is it justified or is it overdone? Well, that's kind of the beauty of markets, that different people have different opinions and everybody's kind of coming and agreeing to transact on a price. And I know we'll kind of talk a little bit more about that later, I'm sure, but regardless of which way you slice it, that's a significant outperformance for growth stocks so far this year. Well, when I think about it, going back to that concept of ratios that we were talking about, right? Fundamental ratios. If you look at a price to earnings ratio of growth stocks, large growth stocks in particular in the US, and you compare that to two things, if you compare it to other parts of the market, and then you compare it to large growth stocks historically, right? So let's think about the price to earnings ratio for the Russell 1000 index, which is 1000 growth index, which is large cap growth companies. That was right around 35. The price to earnings ratio was right around 35. So a multiple of 35 times earnings at the end of July. If I look back over the last 10 or so years, what's the PE ratio been for the Russell 1000 growth index on average? It's been closer to 21. So that's significantly higher than where it's been on average. And then if I look at that same 35 for large growth stocks and I compare it to small value stocks as an example, well, small value stocks are trading at a PE ratio of between 12 and 13. So again, significantly higher. So for me, what does that mean? Well, people are either building in really, really significant growth expectations into the prices of those growth stocks, or they're expecting a much lower return for that investment.
And that's a good point. I think you mentioned about expectations, what investors' sentiment or view is. But in terms of building in that return, whether it's higher or lower, and also one thing I know is talked about a lot in your circle and mine too, is risk, right? How does that risk correlate with the return opportunity or expectations to getting compensated? And it sounds like, some are justified perhaps if those numbers deliver, right? The prices are justified in earnings, whatnot. And maybe those lower price to earnings or lower ratios or fundamentals might be viewed value or cheaper, but there might be something driving that too, and that maybe that's risk, I'm guessing, right? It might be risk and whatnot. So given what you mentioned and given, I think, what we know today, just not even looking at the past, but looking at just the numbers, can these growth stocks keep going? Can they get growthier, right? Because that's a topic I think that you've written about it, people out there are talking about it. And again, I'm not asking you with your crystal ball, but just kind of maybe, what are the thoughts around that?
Yeah, and I completely agree. I don't have a crystal ball. I think that, can these companies potentially deliver on those growth expectations and people, continually wanting to bid up those securities more? That is a possibility, right? I think if you asked me, 3 months ago, did I think that growth stocks could get growthier? I probably would have been saying, I'm not so sure. Those valuations seem very, very wide relative to history, or very, very high relative to history. But again, without a crystal ball, I do think at some point, businesses and markets, it has to come back to fundamentals. That's my personal belief.
Okay. No, and that's great. I appreciate the answer, because again, it's something that I think is talked about a lot, and we'll have to have you back on in a few months or down the road and kind of see how this all shakes out a little bit.
Well, depending on how it goes, I'll agree or not to come back on.
There you go. So shifting gears a little bit, let's kind of put some of the value and growth debate aside for a second. If I'm an investor, this goes into a little bit of what you said a minute ago. If I'm an investor and I'm just looking at new cash, I'm thinking about making changes to my portfolio, whatever the reason, whatever the situation, whatever the need. If I'm looking for higher market returns, where can they look? Where can an investor look to pursue those higher expected returns, as I know you all talk about quite a bit?
Yeah, absolutely. And I think I love the question. I think it's a phenomenal question. I think it might be fun if we just decide to thinking about kind of buying a business together, right? And how we're going to think about valuing that company. Because for now, let's keep the conversation constrained maybe to public equities, because there's a lot of sources, obviously, that somebody has an idea where they can go to and try to get funding. But if we say we're going to be kind of in the public equities realm, and we're talking about valuing the business, is there a favorite restaurant you have, either in Austin or in Colorado?
Yeah, I'll talk about since I'm down in Austin right now as we speak, in your neck of the woods. Matt's El Rancho.
Okay. All right. Matt's is literally a stone's throw from me here, and one of my favorites. Their fajitas are phenomenal.
Oh yeah, they got all the good stuff.
But I'm looking forward to a time when I can go back there. But so let's say we're eating there together, right? We're enjoying a nice cold margarita and some fajitas. And I'm going to just say Matt, because I don't know the owner, comes up and he says, "Mark, this is one of your favorite restaurants. You're in here all the time. Why don't you just take this place off my hands? Make me an offer," right? You're sitting there and you're thinking, let's leave aside the idea that maybe restaurant investments haven't been great for a lot of people, right? It's a tough business. But if you're thinking about making an offer on that business, what are you going to start to look at to try to come up with a bid, right? Try to come up with a price. Think about the building itself and the property, right? I'm pretty sure that they own that property. So that's something that is an asset. I don't know if they've got a mortgage on it or anything else, but we know that if we're going to come up with a bid, it's got to at least cover the equity, right? The assets that they own minus the liabilities that they have. So we're definitely going to have to take that into consideration. I don't think Matt's is known for its wine list, so there might not be a lot of great wine in that inventory, but they got a lot of tequila sitting there. So you got to make sure you at least pay for all that tequila. So we can come up with a value, all the kitchen equipment in terms of, where they make the tortillas and the grills and everything else. So you've got all that kind of sitting there of, okay, we've got the equity, right? So we have to at least be able to cover that and give Matt a fair deal on that. If we take it a step further, we're probably going to need to understand something about the profits, right? What are the cash flows? Because you invest in a business is an ongoing concern, right? So we're going to need to understand how much does Matt's make, on an average Wednesday. You start turning that into a weekly number, a monthly number, an annual number, and we'll kind of have a projection out into the future of what we think those cash flows might be, right? But because we're projecting them out into the future, there's some uncertainty associated with them, right? Say it just so happens that Polvo's, another Boston institution, decides to open up shop right across the street from Matt's, right? And people say, oh, you know what? Matt's looks kind of busy. I'm just going to run across to Polvo's. So maybe, a year from now, Matt's doesn't do so well or as well as they're doing today, right? So there's uncertainty associated with those cash flows. So we're going to assign a discount rate to them to get them back to just the idea basically that $1 today is worth more than $1 in the future, right? So we'll do kind of assess both of those sides, and we'll come up with a price, and we'll go back to Matt and give it to him. And so we basically decided on a discount rate for those future profits. And we might haggle on it a bit. You might say, oh, there's no way Polvo's is going in across the street. You can be certain that this is going to be here a strong business for the foreseeable future, and we'll haggle and we'll agree on a price, right? So that is what's going on every single day in equity markets around the world as buyers and sellers come together and agree to transact at a price, right? Everybody's evaluating different businesses and thinking about the competitive landscape, thinking about new suppliers, pricing pressure, all those kinds of things, and that's getting baked into prices. And so from our perspective, there's a lot of information in that market price that we can use, right? So we talked earlier about this idea between growth and value stocks, and our philosophy is this idea of we want to try to maximize what we're getting for $1 of investment, either in the way of the equity in the company or our share of future profits, right? So what we think, if you're trying to identify where should I be investing my money, well, you want to be able to look at where are companies that have, we call them higher book to market ratios, right? So they have a high level, or said differently, they're trading at a low multiple relative to their book equity. And we want companies that have strong profitability. So we're looking for companies that have both of those characteristics combined, where we've, again, kind of going back to this academic foundation, valuation theory supports why they should have higher expected returns. And there's a lot of evidence that shows that those types of companies have had higher average returns historically, right? So it's up to us to really use that information in prices to find the companies that have higher discount rates, and then we try to invest in a really broadly diversified way across those companies.
No, that's interesting. I think that sets up the price, right? The just in terms, again, not even having the crystal ball, what is it based on the assets, based on the example you gave with the restaurant? And by the way, Matt's and Polvo's would have a killer battle of fajitas.
Yeah.
That battle would never end because that'd be a competition that would be for the ages. But yeah, I think it'll never happen across the street in that close proximity, although they are pretty close already. But so with that question about the price and fundamental, right, kind of come back to fundamentals, just without what's going on in the world of COVID, what's happened in the last 6 months, 5 years, 10 years, just looking at price, looking at those fundamental ratios, is there value then in the capital markets? Again, not your opinion, just using the numbers, pure numbers. Is there value based on those trends or those averages?
Yeah. So I'm a believer that there's always going to be value in capital markets because prices are going to be set at a level where there is a positive expected return, right? People, in general, people aren't thinking about just kind of lending their money to company for free, right? Even with a bond, right? There's going to be a coupon payment, a level of interest that you're expecting above and beyond the risk-free rate. So where you can park your money, in what's seen as risk-free debt, maybe short-term treasuries. So even with higher up in the capital structure, with bonds, you're expected to earn a premium over that risk-free rate. Stocks are further down in the capital structure. So I think of investors as, they're going to set prices at a level where they have a positive expected return. And so there's plenty of research. I know people talk all the time about we're at new market highs, right? Well, new market highs is something that you would expect to continue to achieving. And if you look at the historical research of future equity returns 3 years out, 5 years out, at market highs versus other periods, they're actually pretty similar, right? So it's not that when markets are at all-time highs that all of a sudden it's a really dangerous time to be investing. We can't predict those times in advance. But if you think about being a long-term investor, being a buy and hold strategy within equities is one of the best friends that you have.
And that's good to hear because I think there's value always in markets. I think that's a really good point for investors because sometimes people get too caught up in the noise of the details, the media, folks, having a view on, okay, it's overvalued, pull back, all that stuff that's been going on since the beginning of time. There's a lot of other motives, as we know, that go on in that world. So thanks for kind of clarifying that statement. There's always value in the markets. So it's kind of the next question that leads into this notion of diversification. Common term, we've all heard about it. First term we learned about in finance, possibly, or one of the first terms in this industry. But diversification does not mean everything or the same to everybody, as we know. So real quickly for our audience, I know what your answer might be, but what is yours and Avantis's definition of diversification in your view of the world?
Yeah, absolutely. I think about diversification. So my wife's a dietitian and has a PhD in nutritional sciences, right? So she's the educated one in the family. But she, when she talks about, and her mother's a dietitian as well. So, we've been together a while now, and it's something that I've heard just religiously through time of diversification in diet. So the idea that, you don't, if you're eating just one thing all the time and that's it, that's probably not all that great for you. You want to have color on your plate. We always talk about, so there's that kind of diversification of if you've got a really starchy plate that's all kind of beige, that's not great, right? Get some greens in there, get some reds in there, and when I think about it's not direct, but when I think about investing and I think about diversification, it's kind of the same concept of a diversified portfolio is something that just brings a lot of benefits to it. And when I think about Avantis and how we view diversification, we obviously think about it across companies, we think about it across industries and sectors. We think of somebody's building portfolios, and if we have ones that are investing, in multiple countries, we want to have diversification across countries as well, or regions. And so I think of, in terms of an asset allocation, that global market portfolio is a phenomenal place to start thinking about an allocation, because that's an up-to-date snapshot of, the value of every single business across all the economies in the world. And does that mean that everybody, like, that's the perfect portfolio for everybody? No, right? There are reasons why we might choose to have some differences, right? We're here sitting in the US, investing internationally is a little bit more expensive. There could be some other tax consequences associated with it. So it might make sense for us to overweight the US a little bit more. But you still want to have exposure to all those economies outside the US as well. That's our view. And so whether it's within equities or whether it's across asset classes, I've always thought of diversification as something that can really be your friend. So both in diet and in finances.
No, that's good. And in Avantis, you mentioned that global equity portfolio is a good place to start. Because I think everyone, again, might still get that, but not fully comprehend maybe what you all do. How many companies on average wouldn't have, like, if you guys just hypothetically just said, hey, here's an Avantis global equity portfolio, and whether it's a hypothetical portfolio or a live portfolio, how many companies would exist in that? Is it dozens, hundreds, thousands? I mean, what is it like?
Yeah, so if you think about the global equity marketplace, right, there's at least 14,000 publicly listed stocks across developed and emerging markets. It's a huge number. And so if we built a global portfolio with the Avantis approach, we would have thousands of companies in there. And that's, again, it's that idea of if I don't need to concentrate in one or two or three companies to be able to get a good return, a good investment experience, then why would I take on that additional kind of concentration or idiosyncratic risk?
That's great. So it sounds like it's a better way to manage the risk, is what I heard. And I think that's great, because I think a lot of folks still might have the perception that owning certain areas or overweighting or maybe just a smaller number of stocks, it doesn't compensate them, or it leaves risk on the table. So that's good to talk about. And I think that leads into kind of a couple of our last questions about, so let's assume for a second that we're diversifying globally, right? Everyone is getting some piece of the market, maybe not to the level you all might do it, but somewhat reasonable. And maybe they're pursuing higher expected returns, right? They get it. They say, you know what? We like the fundamental aspect. We think that makes sense. Okay, let's own some value companies along with everything else, and maybe more of them, hypothetically. But there's this talk about again, I'm kind of a data guy. I think like you are, and a lot of your team members are. You look at some of the data, and over the last several years and decades, you see this smaller number of companies that actually represent those that actually go up over time. And a lot of the market doesn't go up. A lot of the market, they may still be around, but they kind of falter. Some go out of business. And I think the number, your math's probably better than mine, but I think the number I've heard is something like 25% on average of stocks only go up over time, and the rest kind of do with their something else. Maybe talk to me about that, because that would, for some investors, they might think, well, why would I then go buy all these thousands of companies across the world if only a small number of them go up?
Yeah, no, and I think that that question, there's a lot behind it, and when I think about some of the biases that can creep in, that and it gets into some of this more of the behavioral stuff too. There are components that I think might be worth hitting on, but when I think about trying to identify those companies ex ante of what are the 15, the 20, and we can talk about just across all markets, or we can talk about even within markets, within asset classes, so subsegments of a market. Identifying those ones in advance of these are definitely going to be the winners. Really hard. There's a lot of people have a lot of strategies that are looking to do that, right? There's people that are out there making pretty concentrated bets on, I think this company is going to be better than that company. And the evidence that we see over really long periods is that's a very, very challenging endeavor. And I think, from my perspective, that idea of it reinforces for me that if there's a smaller percentage of them that actually go up through time, that you want to make sure you're owning them, right? You want to make sure you have some of your investment in those companies, because when we look at capital markets overall, right, the U.S. stock market over the long haul has done about 10% a year. What's the safest way to guarantee that you earn that 10% a year? It's holding the entire market, right? That's the safest way to ensure that you enjoy that equity premium. And that doesn't mean, that the equities are always going to outperform T-bills over every single year. We were kind of talking about this with value and growth earlier, but the long haul numbers tell us that that you have been rewarded if you've been able to stick with it. And so for me, it definitely, it's even more of kind of a shot in the arm to say, make sure you practice diversification in your portfolios to make sure you're holding the companies that are going up. I think about 401k plans. I used to be a pension consultant, and company stock, right, used to be very, very prevalent in 401k plans, and in a lot of cases, it may have been the majority holding that an individual had inside their 401k plan. And there's a lot of kind of, heuristic or behavioral things going on there of, I know this company really well, I trust these people. And sometimes that can work out, but sometimes that can be detrimental if you have, an Enron kind of a situation. And so there's a reason that you see less of that you see, from a fiduciary practices standpoint, people baking in more options and more broadly diversified low cost options. So in my mind, it really reinforces that diversification is a good thing. It's your friend. You want to embrace it wherever you can.
Yeah. So that kind of leads me to a question. With these, whether it's a smaller number of names, especially driving the market, so you want to capture those because it's hard to predict which ones. And going back to the fundamentals, right? Where we started with this whole notion of value and growth stocks. If let's say value stocks, and the data suggests that these are the higher expected return stocks, and investors agree with what you just said and say, I feel that makes perfect sense. We're data number guys too. Let's invest. Why bother with anything else? Let's just buy value. Let's just buy the higher expected return stocks. Should investors just buy value?
Well, I'll say that I think you might be better equipped to answer this question than me. And so I want to hear what you think on it, but I can give you my perspective is that it's probably different for different people. And I think that what it comes down to is this idea of any investment strategy, right? Anything that we're going to come up with of this is what I think I want to hold or what I want to own, that has to be within the context of a broader financial plan, right? Of what are the goals? What does risk mean? What do we think future liabilities are going to be? The investment strategy and the assets, so where we decide to deploy them, they're meant to support a future goal, a future need, right? So anytime we're saving, we're defraying some kind of or deferring some kind of a benefit that we could consume. We could have consumption now in the hopes that we have more in the future for doing it. And so, there's history, there's data in the U.S. market, anyways. There isn't a 20-year period in history where small value has lagged the market, right? There's no 20-year period where small value has lagged the market. Within every single one of those 20-year periods, there's very painful sub-periods where U.S. small value does lag the U.S. stock market. And so there's a bit of, well, what am I setting up this allocation to try to achieve? How much can I stick to it, right? Am I willing to deal with the volatility that comes with equities only, or investing in a subsegment of equities like small value? Those are really important questions, because I think the last thing you want to do is make an investment that you can't stick with when the times are hard, because undoubtedly you will face hard times. And for us, like, if you want to get the long-term positive expected benefit, you've got to be able to stay in your seat when the going gets a little bit rougher.
Yeah, and that's a good point, because I think even just regardless if it's growth or value or big companies, small companies, just stocks and bonds, right? Not everything. Those vary year over year too, and there's some painful periods as well. And to answer your question about the planning, you're right. The planning that drives everything, but I think it's easy to say, whether it's a period of just looking at the numbers or looking at a big run that value may have had, like it's had in the past. It's easy and I've seen that in some circles, we'll call it, where some people do load up a little bit more and take bigger bets, because with the time you start loading up, it becomes more of a bet, I think, in our opinion, of value. But we'd argue and say you should own both, right? You should own both. Just a matter of that preference, how much you want to tilt to the needs. And hence, when the question comes right now, like we're hearing out there on occasion, or you're seeing in chatter about the growth, will it continue? Shouldn't we just own more of that, since that's the one that's been doing the behavioral aspect, right? We'd say no, and you should probably own both, a matter of preference of how much of each. So I appreciate the discussion. This has been great. I think a lot of good points for our audience. Phil McInnis, Avantis Investors, thank you so much for joining us today. We'll have to have you back again, like I said, in a few months, and revisit how the world's moving forward with growth and value and everything else in between. So thanks again for the time, and thanks everybody for the time as well. We'll talk to you all soon.
Thanks, Mark.